This video explains exactly what happened under ancient Mesopotamian law when a person could not repay a debt, using the actual surviving text of the Code of Hammurabi to show how debt slavery worked, who it affected, and why ancient kings periodically canceled debts across the entire kingdom. Most people assume debt is a relatively modern problem, something that comes with credit cards, mortgages, and bank loans. The historical record says otherwise. Some of the very first written laws that survive from human civilization deal directly with what happens when someone cannot pay back what they owe, and the consequences were far more severe than anything in a modern credit report. By the end of this video, you'll understand the actual mechanics of debt in one of the earliest civilizations on Earth, and you'll see a pattern that, in some form, has repeated throughout financial history ever since. Mesopotamia, the region between the Tigris and Euphrates rivers in what is now Iraq, was an agricultural society built around predictable yearly cycles of planting and harvest. This created an obvious problem. Farmers needed grain or silver to plant their fields long before they had any harvest to repay it with. Temples and wealthy individuals filled that gap by lending grain and silver to farmers, charging interest on the loan. Documented interest rates on these agricultural loans were substantial, often around 33% annually when repaid in grain. This was not informal or undocumented lending. Mesopotamian society kept extensive written records of debts, contracts, and obligations on clay tablets using cuneiform script. We know these interest rates and lending terms today because thousands of these tablets have survived and been translated by historians. A 33% annual interest rate on a loan you needed simply to survive until harvest meant that a single bad year, a flood, a drought, a failed crop, could trap a family in a debt they had no realistic way to escape on their own. This is where the Code of Hammurabi becomes essential. Hammurabi ruled Babylon from approximately 1792 to 1750 BC, and toward the end of his reign, he had a set of laws inscribed on a massive stone pillar, addressing nearly 300 different legal situations. Law number 117 addresses debt directly. The surviving text reads, in translation, if a debt has seized a man, and he has sold his wife, his son, or his daughter for money, or handed them over to work off the debt, they shall work in the house of their buyer or creditor for 3 years, and in the 4th year, their freedom shall be established. Read that again slowly, because it is worth sitting with. This was not a hypothetical scenario or a moral warning. It was an actual, functioning law, describing the literal legal mechanism by which a free family member became someone else's laborer because of an unpaid debt. A father, under genuine financial pressure, could legally sell his wife, his son, or his daughter into another household service to settle what he owed. They were not enslaved permanently in the way we typically think of ancient slavery. The law specifically built in a release after 3 years of labor. But for those 3 years, they belonged, in every functional sense, to the household that had purchased them. Picture what this actually meant for a real family. A father, unable to repay what he borrowed, faced a choice between defaulting entirely or handing over the people closest to him. They were not enslaved permanently in the way we typically think of ancient slavery. But for 3 years, they belonged in every functional sense to the household that had purchased them, performing labor in a home that was not their own. The 3-year cap was not an accident, and it tells you something important about how Mesopotamian society understood the danger of unlimited debt bondage. A system where debt slavery had no endpoint would eventually concentrate an enormous portion of the population into permanent servitude under a small number of wealthy creditors. Babylonian society, and the kings who governed it, appear to have recognized this risk directly. The 3-year limit functioned as a release valve, ensuring that even the worst-case outcome of financial failure had a defined endpoint rather than becoming a permanent, inherited condition. This wasn't the only protection built into the system. Another law in the same code addressed what happened when a natural disaster destroyed a farmer's harvest. If a storm or flood wiped out a man's crops in a year he owed grain to a creditor, the law stated he did not have to make that year's payment at all. He could, in the language of the law, wash his debt tablet in water effectively voiding that portion of the obligation because the failure was outside his control. Individual protections like these addressed single cases, but Mesopotamian rulers also recognized a larger, society-wide problem. When enough people across the kingdom became trapped in debt simultaneously, it threatened the stability of the entire economy and the king's own tax base. Their solution was something modern economists now call a debt jubilee, a kingdom-wide cancellation of outstanding debts, ordered directly by the king. Hammurabi himself is documented to have issued these general debt cancellations multiple times during his 42-year reign, in 1792, 1780, 1771, and 1762 BC. These were not isolated, one-time events. They appear to have functioned as a recurring tool of governance, used specifically to prevent the kind of runaway debt accumulation that could destabilize the kingdom. The anthropologist David Graeber, who studied the history of debt extensively, made a pointed observation about these jubilees. The kings issuing them were almost certainly not acting purely out of humanitarian concern for their subjects. A kingdom where most of the population was trapped in debt slavery to private creditors was a kingdom where the king's own authority and tax base were being quietly transferred into private hands. Canceling those debts was, in part, a way for the king to reassert control over his own kingdom. This 4,000-year-old system reveals something that remains true in every debt-based economy since. Unlimited, uncontrolled debt accumulation tends to concentrate wealth and power in the hands of creditors, often at a pace that becomes socially and politically unsustainable. Mesopotamian society addressed this with hard limits: a 3-year cap on debt slavery, automatic forgiveness for losses caused by natural disaster, and periodic, kingdom-wide debt cancellations ordered from the very top of the political system. Modern economies handle the same underlying problem very differently, through tools like bankruptcy law, statutes of limitations on debt collection, and government intervention during financial crises. The mechanisms have changed dramatically. The underlying tension between lenders seeking repayment and borrowers facing circumstances beyond their control has not changed at all. The Code of Hammurabi survives today, carved into a 7.5-foot stone pillar, now housed in the Louvre Museum in Paris. Reading Law 117 directly is one of the most concrete ways to understand that debt, and the very real human cost of being unable to repay it, is not a modern invention. It is one of the oldest recorded problems in human civilization, and societies have been experimenting with ways to limit its damage for at least 4,000 years. That is what actually happened when you could not pay your debts in ancient Mesopotamia. Thank you for watching.